My name is Miyako Urabe, and I'm Portfolio Manager of JPMorgan Japan Small Cap Growth and Income. I have 15 years of industry experience, of which 10 years have been spent at JPMorgan Asset Management, focusing on Japan equities. I've been a named manager on JSGI from first quarter of last year, 2022. I work together with my colleagues Naohiro Ozawa and Shumin Tao on JSGI. We have a very large team of over 20 portfolio managers and analysts located on the grounds in Tokyo, and we believe that this is very important. Now, this is because the Japan equity market is very poorly covered by the sell side, and the coverage particularly tends to fall off in the mid and small cap space. We believe that it is crucial to have a large local presence and be able to conduct thorough research on our own without depending on the sell side. And as a team, we conduct over 4,000 company meetings per year. The trust started in 1984 as JPMorgan Japan Smaller Companies Trust, focusing on mid and small size companies within the Japan equity market, which is an under-researched, underexploited part of the market. The trust changed its name to JPMorgan Japan Small Cap Growth and Income in December 2020 to better reflect the current investment objective and the dividend policy. So JSGI focuses on growth and quality companies. We take long-term views and we are bottom-up stock pickers. There is also a dividend of 4% annualized return for investors. We believe that the first and most important positive development we're seeing in Japan is the improvement in corporate governance. Now, this isn't something that just started today. The momentum has been building over the past few years. Ever since former Prime Minister Abe came into position, he pushed forward the corporate governance code, the stewardship code, and over time we have seen a consistent improvement, be it the ratio of independent outside directors on boards or the improvement in disclosures from corporates. And on top of this building momentum, earlier this year, the Tokyo Stock Exchange came out with an initiative telling companies where their share price is consistently trading below price-to-book ratio of 1x that they should announce specific initiatives to address this. Now, this is a big deal, domestic pressure on domestic companies, and we did not have that before. Now, just to think about the significance of this, Japan has a much higher ratio of companies trading below book value compared to US or Europe. And on the other hand, a high ratio of Japanese companies have net cash positions. So if this starts to change, there can be a significant impact. And despite these positive developments that we see, when you look at valuations, the Japanese equity market is not at all demanding, and the current valuations of the market are cheap, both relative to history and also compared to other major markets. And it is also a market that is relatively under-owned. I think most global investors are still underweight Japan, and many people haven't looked at the Japan market for a very long time. Now, within the Japan market, I want to talk about the attractiveness of the mid and small cap space. Now, the key point here is that the Japan equity market is very poorly covered by the sell side, and that coverage particularly tends to fall off in the mid and small cap space. So that can create an excellent opportunity for active managers, and we believe that it's important to have a large local presence and identify the hidden gems with strong competitive positions. Another differentiation of the trust is the 4% dividend yield paid out. Another important positive development in Japan is that we see signs of inflation. Now, I think it's very important to understand that Japan is at a very different stage when we talk about inflation. We are a country that suffered from deflation for a number of decades, And the inflation levels that we're seeing are the highest levels in the past few decades, but it's nowhere near the levels that you're seeing in US or Europe. And at the levels that we're at, we believe that this kind of inflation can be very supportive for the domestic economy and consumption. There's a number of areas that we're focusing in the market, so I'd like to give a few examples. Well, firstly, demographic change. Now, it's no secret that Japan's population is aging and falling, and that can be negative for the economy overall, but there can actually be trends that emerge as an effect, and that can create a very good opportunity for active managers. For example, a structurally tight labor market can mean that areas such as staffing companies or HR technology companies can be well positioned. For example, we own a company called Benefit One, which is the domestic #1 provider of corporate fringe benefits. Now, the demand for fringe benefits are increasing as corporates want to provide more incentives to staffs as it's becoming more difficult to hire and retain people. Another example of a theme that we focus on is digitalization. Now, Japan is good at and advanced in many things, but actually digitalization is not one of them. And we are a number of years behind the West when it comes to things like e-commerce penetration, cloud software services, cashless payments, but we're traveling in the same direction, just with a time lag. So in fact, we can look at the trends that are occurring globally and think about potential beneficiaries in Japan in future. For example, we own a company called Infomart, which is the #1 provider of cloud ordering system for restaurant industry. So that is connecting restaurants with their wholesalers. Now, the ordering used to traditionally be done all by telephone or facsimile, and Infomart is the de facto standard of bringing that online. And finally, world-class brands. So we invest in a number of world-class consumer brands. For example, we invest in gaming companies such as Square Enix and Capcom. These are two companies with very strong, globally popular video games. We also invest in a number of B2B niche top companies. For example, Nakanishi is the global #1 provider of dental handpieces. JSGI invests in growth and quality names, companies that can compound growth over the long term. If you look at the portfolio characteristics, the portfolio has a higher return on equity, higher earnings growth rate compared to the benchmark. Balance sheets are also stronger. Looking back at 2022, it was a very difficult period for us as the market started to focus more on inflation and rate hikes globally, and you saw a very strong reversal into value names, and the growth and quality names that we invest in struggled. Now, despite the short-term volatility, we believe that it's very important to think about the long-term outlook, and we continue to focus on growth and quality names that we believe can continue to grow earnings over the long term. The trust also has the ability to borrow, and we can position from 5% net cash to 15% gearing. We do take advantage of this as we are positive on the mid and long-term outlook of the market. Following short-term volatility and difficult performance in 2022, the current forward price-to-earnings ratio of the portfolio is the lowest levels that it's been over the past decade, and we believe that the current valuations are attractive considering the quality of the companies that we're investing in.